Good afternoon. Hope everybody's doing well. Hopefully you are staying calm and able to make it through the craziness in the markets here lately. This week, we got a lot to cover. We're going to talk about the jobs week last week, break that down and kind of share some perspective around some of the numbers that came out late last week. Of course, we will spend some time on the updates around the Russia-Ukraine tensions. And we're also going to give a little bit of a preview for what may be to come next week as the Fed meets and Fed Powell goes through his press conference on Wednesday. I have to share right out of the gate, I am super excited. I'm actually going to Arizona this weekend, just kind of a quick weekend trip, but I am so excited to finally get some sunshine and hopefully thaw out here a little bit. And maybe, honestly, get away for a day or two from just this craziness in the markets. I feel like it's going to be very nice. So last week, for those who follow us, you may remember Adp Employment Report came out on Wednesday last week. That number was great. It showed 475,000 jobs added for the month of February, which was just incredible. It's a great number. We talked about hopefully this is a sign of some great news to come. But I guess to be fair, for those who do follow us month to month here, unfortunately, the ADP employment report doesn't always do the best job of showing what that can look like. It's supposed to be a little bit of a tip of the cards for non-farm payrolls, but sometimes the number comes out a little bit cattywampus. So this week, the good news is that it was a good sign. Moving into late last week on Thursday, initial jobless claims were lower than expected. Another, good number in that trend line. And then on Friday, we also had non-farm payrolls come out, and it blew everyone out of the water. Added 678,000 jobs for the month of February. So this was an awesome number. It was very, very good to see this as far as a sign of our jobs market and hopefully what may be a continuing trend moving forward. However, markets still weren't really too excited, and primarily due to, as you might imagine, a lot of the tensions between Russia and Ukraine. So, what we'll do is as we start to break today, instead of a question of the week, we will talk a little bit more about what's going on there, kind of the latest and some things that we're watching. But really, that's been the story. As good as these jobs numbers were, they weren't enough to offset some of the negative news, obviously, with the challenges between Russia and Ukraine right now. On top of that, Wednesday this week, we had job openings come out, and this was not necessarily a good number. We have 11.3 million job openings right now, which is just, it's amazing. I mean, it's a huge, huge number. Obviously, it's great to see this jobs data come out last week, and hopefully that some of these jobs are being filled, but there's still a lot of work to do. So hopefully this trend kind of continues moving forward. And what I want to maybe talk a little bit about is also the Fed meeting coming up next week. So get ready. Next week, we're going to spend a lot of time. We've got inflation data coming out and retail sales, but most of next week, we'll be breaking down the Fed's comments and what they had kind of suggested or their path moving forward. Today, what I want to spend a minute on is talking about what we expect or might see on Tuesday and Wednesday next week, and how that may or may not impact markets, right? So with everything going on between Russia and Ukraine, we had Fed Chair Powell testify, actually, I think it was last week. And really what he had basically laid out his cards. I don't expect that he will make any changes to what he said last week, because if he does, that will have an impact on the markets. I think the Fed generally has been very, very accommodative towards the markets. I think they may still, although they realize that they do need to do something, but I don't imagine that they're going to throw out any wild cards or do anything that's just radically different from what they've been talking about. So just last week, what they had basically said is that they are planning on doing a 25 basis point, a 0.25% hike, basically each meeting moving forward. They all but took the 50 basis point hike off of the table last week. So I don't expect that we'll see a 50 basis point hike. I don't expect nothing. I don't expect any more or less, but I think 25 basis points is probably what we'll see coming up next week. On top of that, there's also, so the interest rates is part of what they can control. They can also control asset purchasing or slowing of asset purchasing, right? They've been buying bonds for a while now to help keep some liquidity in the markets and keep interest rates low. What I think that they will do on that front is kind of what they had communicated last week. I don't expect that they're going to get more aggressive with that. I think they'll stick to their original plan, which I believe was slowing down until I think it was like July or so is their target to basically be at a neutral stance for buying and selling. I don't expect them to increase that or anything along those lines at this meeting. In the future, if Russia and Ukraine tensions start to slow, it's possible that comes back on the table as far as getting more aggressive. But with what's going on right now and what he had shared last week, I imagine it's going to be pretty status quo of a 25 basis point hike and continuing the asset purchase plan that they've already kind of set forth. So we'll break this all down next week. Obviously, I do not have the crystal ball, and so it'll be very interesting to see what happens. But generally, that's what we're expecting. And next week, we'll talk about what happens. If this is the case, most likely not a big market mover. Obviously, who knows what happens with Russia and Ukraine by that time. But the Fed itself, I think, is trying to take itself out of the equation here right now, try and minimize uncertainty, in fact, was what he had said exactly. And so, I don't think it'll be much of a market movement. I think the market, for the most part, has probably already priced in a lot of that. As for our question of the week here this week, again, I just want to spend a little bit more time on the Russia-Ukraine tensions. And what I want to talk a little bit about is what has been a little bit of a flip of a switch. So leading up to this point, interest rates were really a huge driver of stock markets. As interest rates rise, markets would pull back for probably the last, let's say 2 years, really, at least a year anyway. What I think has happened recently is now interest rates are not really the driver. And it really, when it was interest rates, it really affected tech, right? When interest rates rise, we saw tech really pull back. Now, what has, I think, started to happen is people are understanding that this cost of oil, especially, or let's just say commodities in general, but really it's the cost of gasoline, has gone up significantly. And the American consumer is really sensitive to that, right? If all of a sudden it costs us, $100 to fill up our tank, well, that's now $100 less that we may have for going out or whatever it might be. You've heard me talk about this multiple times. So what has happened now is it seems like it's commodity prices that are really driving the market up or down. On Wednesday is a really good example. Like commodities pulled back a little bit after a good run, and stocks jumped up quite a bit on that. Earlier in the week, commodities were doing extremely well, and stocks pulled back quite a bit. So whether that continues and for how long, who knows? But I think now it's not as much of a, don't get me wrong, interest rates are still important, but the Fed has communicated they're not going to surprise us. And so now I think commodities are what is really driving a lot of that, under the understanding that if commodities do continue higher, there could be some other challenges that we face down the road. So I think that's really important to pay attention to. Instead of just the stocks and bonds conversation, it's really important to also pay attention to commodities. It has been for the past, 6 months or so for sure, but especially now that, there seems to be an inverse relationship there between the two. So with that, we will look forward to seeing you next week. Of course, if you have a question you want us to cover next week, please do let me know. And if we end up using yours in our market updates, I'll be sure to send a copy on me. In the meantime, have a great upcoming weekend. We'll see you next Thursday and break down everything that the Fed has to offer next week.